Welcome. Today, we're diving into the double entry system of accounting, a foundational method that keeps every transaction in perfect balance. For every debit, there's a corresponding credit. This system ensures accuracy and helps businesses track where their money comes from and where it goes. Whether you're receiving cash, making a sale, or paying an expense, double entry keeps your books balanced. Let's start by understanding why this method is so important and how it forms the backbone of modern accounting. Ready to see how it works in real life? Let's move on to some practical examples. The double entry system, every transaction affects at least two accounts. For example, when you receive money, you increase your cash or bank balance and record who gave you the money. If it's a cash sale, you don't need to track the buyer as a debtor. The transaction is complete. The sales account gets credited, and your bank or cash account is debited. For credit sales, the person who owes you is debited, and sales are credited. This method ensures all outcomes are recorded, giving you a complete financial picture. When you buy goods or services, the double entry system helps you track expenses and payments. If you purchase on credit, you debit the expense account and credit the creditor's account. For cash purchases, the expense is debited and the cash or bank account is credited, reducing your available funds. This approach applies whether you're paying rent, buying inventory, or acquiring assets like vehicles. The system ensures that every dollar spent is accounted for, making it easier to manage your business finances. Let's look at a practical example. Suppose the owner deposits $100,000 to start the business. The bank account is debited, increasing your assets, and the owner's loan account is credited, recording the liability. Next, you pay $3,000 rent. Rent is debited as an expense, and the bank account is credited, reducing your cash. This simple rule applies to all expenses. Paying cash for an expense increases the expense account and decreases your bank balance by the same amount. The same principle applies when buying assets like vehicles. Now let's see how sales and inventory work. If you buy goods for $20,000 and sell them for $40,000, the cost of sales is debited, and the bank is credited for the purchase. When you sell, the bank is debited for the cash received, and sales are credited. This process helps you track both your profit and your solvency. The sales account shows your income, while the bank account shows your available cash. Keeping an eye on both is crucial for business success. All transactions are first recorded in the journal, then posted to the general ledger. The ledger keeps running totals for each account, making it easy to extract balances when needed. For example, the sales account accumulates all sales, while the cost of sales and expense accounts track outflows. The bank account reflects all deposits and withdrawals. This organized system allows you to quickly see your financial position and ensures nothing is missed. Check your work, prepare a trial balance. This lists all accounts and ensures total debits equal total credits. The difference between income and expenses is your net profit, which is carried down to the assets and liabilities section. This process confirms your books are balanced and helps you spot errors early. In computerized systems, debits are positive and credits negative, and the total should always be zero. This step is essential for accurate financial reporting. Today, most payments are made electronically, by debit card or EFT. When you buy stationery or fuel with a debit card, the expense is debited and the bank account is credited. For goods bought by EFT, the same rule applies. When you sell goods and receive payment by EFT, the bank is debited and sales are credited. This method keeps your records up to date and matches modern business practices. Let's look at a few more examples to reinforce these concepts. As businesses grow, buying and selling on credit becomes common. When you buy goods on credit, you debit the expense or inventory account and credit the creditor's account. When you pay later, you debit the creditor and credit the bank. Similarly, when you sell on credit, you debit the debtor's account and credit sales. When the debtor pays, you debit the bank and credit the debtor. This system ensures all credit transactions are tracked until settled. Expenses, like depreciation, are recorded to reflect the loss in value of assets over time. For example, a vehicle bought for $100,000 may be depreciated by $20,000 per year. Depreciation is debited as an expense and credited to a provision account. Similarly, provisions for expenses like audit fees are made when the service is partly complete but not yet billed. This ensures your accounts reflect all costs, even those not yet paid, giving a true picture of your financial health.